Welcome to our latest quarterly update. I'm joined once again by Greg Hirt, our Global CIO Multi-Asset, who will take a look back, a look forward, and shed some light on his current portfolio positioning. Good to see you again, Greg.
Well, thank you for having me back here.
So, looking back, what's happened over the last quarter?
Well, overall, economic indicators surprised in the first half of the year, with the weakness in the housing market and manufacturing sector compensated by strong services sector and excess saving. So while we are not out of the woods in terms of recession risk, the timing might have been pushed a bit further down the road. Further good news across the Atlantic came with resolution of, for now, the issue of the US debt ceiling. A default scenario has now been priced out. Also interesting in May was the notable rally of large US stocks, driven in large part by enhanced revenue projections for artificial intelligence applications. Indeed, this rally was particularly impressive given the persistence of inflationary pressures and rising rates. Turning to Asia, Japanese equities also enjoyed a strong May, driven by a favorable economic outlook, supportive monetary policy, and also increasing efforts by the Tokyo Stock Exchange to improve corporate governance. On the other hand, while China economic recovery has been a shade weaker than expected, partly due to the need to balance short-term growth with long-term sustainability. As such, disappointing economic data in May led to a slide in Chinese equities as well as in broader commodities market.
Thanks, Greg. And could you give us a little idea what you expect to see in the coming quarter?
Well, in the current market environment, the focus of course remains on inflation, especially core inflation, and then the reaction function of central banks to those rather sticky numbers. Indeed, while headline inflation has come down substantially, as we had expected, core indicator, excluding the volatile energy and food components, well, they remain stubbornly high. For example, just last week, we saw private sector wage growth in the UK accelerate to 7.6%, faster than many had expected. This means that while central banks like the Fed could be closing their hiking cycle, well, it may well be that they remain at current levels for longer, avoiding a pivot in 2023. This, in the medium term, will be clearly a negative for markets. We must recognize that with the debt ceiling resolution in the US, better than expected economic data, and still loads of cash on the sidelines, we have the ingredients for another leg of potential upside in equity markets, while the Damocles sword of recession and liquidity reduction still loom in the longer term. One key topic we should not ignore, of course, is the hype around artificial intelligence. To be very clear, valuations seem quite expensive and stretched, and earning expectations can be questioned. But we have experienced such hypes before. They can last for quarters, if not years, and support a market before they deflate.
Thanks, Greg. Insightful as always. Given these developments, maybe you could shine some light on your current portfolio positioning.
Well, given the circumstances we have discussed, we maintain a tactically moderately positive positioning on equities. Fundamentally, we continue to like emerging markets despite a disappointing first half, especially as overdone expectations for China have now calmed down. Our regional preference go for Europe and Japan, still supported by more constructive earning trends and valuation. Now, the US remains expensive, explaining our more neutral stance overall. With respect to fixed income, our preference is a notch more supportive on US treasuries and gilts, and somewhat cautious across all other sovereigns. Our most negative view goes for Japanese bonds, where we believe that the Bank of Japan is still wrongly anchored to the former deflationary environment. Despite a structurally optimistic view for oil, we have tactically revised our stance on commodities to become more neutral, as the short to medium-term outlook is not supported by our systematic indicators. Nevertheless, we will add further to our gold position if prices offer more attractive entry levels. On Forex, we maintain a positive view on the Japanese yen, on expected Bank of Japan activity and its regained status as safe haven. As most investors are now long euro versus dollar, the tactical case for euro has faded a little bit, even though valuation remains supportive in the longer term. Finally, and very critically, equity volatility is at a very low level, which allows for relatively cheap hedging through option strategies. As potential tail risks remain, we appreciate the possibility to cover large downsides.
Thanks, Greg, for your insights today. And thank you for joining us, and we'll see you again at our next quarterly update.
And also from my side, thanks a lot, and see you in 1 quarter.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。